central banks would think that they're smarter than the economy. Instead of letting the economy weed out all this debt and excesses in the 2008-9 downturn, which should have lasted into 2010, more like 1929 to 32 crash. It should have been deeper, last longer. That would have purged all these debts and zombie companies, and we could have come out this healthy. Instead, they've just kept the debt economy going on nothing but printed money. And now we're going to have a greater crash years later. And I think it's starting now.
It is my pleasure to welcome Harry Dent back to the show. I think he's been on maybe a dozen times now, and it's great to have him. He's coming to us from his home in Puerto Rico, where the taxes are low. And we want to get an update on Zero Hour, his latest book, as well as the demographic cliff, and also talk, of course, about this crazy overheated economy and all the shortages. The last time we saw Harry was about a year and a half ago when he spoke at our online virtual event for Empowered Investor. So it's great to have him back. Harry, welcome. How are you doing?
Nice to be back, Jason.
It's good to have you. Good to have you. What is the latest? We are living in crazy times, aren't we?
We are, very short story. We had the greatest boom in history, which I was one of the few to call back in the 80s when it was just getting going, because the baby boom was going to grow up, earn and spend money, and the largest generation in history was basically a slam dunk, but it's not the type of thing economists study. So we're going to see the greatest boom in history. But I also said it's going to peak by late 2007, which it did, and we went into the worst downturn since the Great Depression in 2008. Well, what happened? That the Federal Reserve and the central banks around the world just panicked, because it did look. Ben Bernanke was the chairman back then. He's like, oh my God, I studied the Great Depression, looks just like it. And they just have been printing money nonstop ever since. So we have the most perverted economy in history. We've been running on total money printing. And of course, it takes exponentially more to keep a debt economy going. Again, my research showed from the beginning that when the baby boom peaked in 2007, after this great boom starting in 83, that we would see a 14-year sideways movement slowing, and we wouldn't be coming out of it until about 2023, 24, just ahead now. But what do we have? Stocks at all-time highs, because they keep pumping up the economy. And that money that they're printing, they're not sending us checks in the mail, which would be a better thing to do if you're going to irresponsibly print money and hype up economy. They're just buying bonds with it and injecting that money into the financial markets, which creates the greatest bubble in stocks and financial assets. And that favors the rich even more than this great boom was favoring the rich over the everyday people. So we have greater income inequality. We had bubbles into 2000, the first tech bubble, second bubble into 2021 here, but we also had a minor one into the baby boom top in 2007. The point is, this final bubble here, 120% artificial, nothing natural, no demographic trends, no technological trends. All of my cycles on those, which are very predictable and definable, have peaked. And so we're running on money printing alone, and they're having to print more and more to keep this going. And I am showing signs right now that we may be finally peaking in this artificial stock bubble, which will be studied in history for decades. Believe me, they're going to go, what were they smoking here? To think that once an economy went to a downturn after a major generational surge in spending, that you can just print money and keep it alive on nothing.
I couldn't agree more. And Harry, the wealth transfer that is happening right now is absolutely staggering, isn't it? And like you alluded to, if they want to print money, the least they could do is just send everybody a check. Yeah. That would be much more equal.
Send it to everyday people, because this is creating it's creating a modest economic boom, because we're just countering a downturn, but it's primarily creating the greatest financial asset bubble in history. And of course, the top 20% control 88% of the assets, and the top 50%, 2% control 50% of the financial assets. So it's really creating greater imbalance just to keep something going, because everybody's scared oh, if we have a recession, things will fall apart. And you know what the answer to that is? Yes, they will.
Yeah.
They will fall apart like they did in 2008.
They'll fall apart and rebuild, though.
That's what happens. See, the economy is smarter than economists.
Right.
The economy knows how to repair itself when it gets out of balance. What economists are saying, oh, we fostered a bubble even more than it would have been after the baby booms and stuff, and now we don't want it to burst because it's going to make us look horrible. Well, it will, but the economy knows how to rebalance, get rid of bad debts, get rid of zombie companies. We have the greatest debt bubble in history, all types of bad debts out there, and 31% zombie companies that can't pay their debt service, which are only being kept alive by them keeping this dead economy alive. So I called it, I was about to name my last book, The Greatest Crime in Modern History. The central banks would think that they're smarter than the economy. Instead of letting the economy weed out all this debt and excesses in the 2008-9 downturn, which should have lasted into 2010, more like 1929 to 32 crash. It should have been deeper, last longer. That would have purged all these debts and zombie companies, and we could have come out this healthy. Instead, they've just kept the debt economy going on nothing but printed money. And now we're going to have a greater crash years later, and I think it's starting now. I think we're very likely in the first crash of this big crash, which really, should have come earlier. And if so, we're going to see a lot steeper fall just ahead. If not, we might see one more new high and then see such a crash. But the way you're going to know this bubble's finally over, when you see stocks down, and listen to this, over 40%, probably closer to 50%, in less than 3 months. That's the only way, and I've studied this in history, to tell when a bubble's burst, because bubbles just go with all this enthusiasm and they get crazy, but that first crash, when it's that steep, that soon, it tells you it's over. I think we may already be in that crash, and if we are, stocks are going to be a lot lower by the end of March. If not, we're going to see this first crash, I think, by mid this year at the latest. I think we're probably in it right now.
Yeah, the stock market is definitely showing signs of distress, no question about it. Harry, take us through this chart we have on the screen, but just note that some people are listening on audio only and not seeing the video. So what is it telling us? Okay, this is Dow Jones Internet Composite Index versus leading stock Amazon. What does that mean?
Yeah, this is the on top, it's the blue is the internet index going back in the late 90s when we had the first tech bubble, right, and Amazon being the lead stock. And I'm comparing that today to the kind of the NASDAQ, and then the leading parts sector, which is now crypto, just emerging. So what you get is this chart is showing back in the late 90s, the first bubble, how we had a bubble in the overall internet index, which was the leading part of the NASDAQ back then, like crypto is today. And then the red line here is showing Amazon, which was the leading .com. So what I do today is I say, look, this has happened before. We had the first tech bubble from 95 into early 2000. It was led by the NASDAQ, and the latest stage was when the .coms, people don't realize Amazon was just went public. I think it was in 1997 and became something in 98. And so it was one of the biggest bubbly stocks like the cryptos today. And it was wildly overvalued because they thought it was going to grow to the moon. And then the whole thing collapsed. So what we're showing here, how the first bubble formed, led by the internet sector of the NASDAQ and the stock market, and then Amazon is the leading stock there, and they crashed. The point here, Jason, of this chart, that first crash out of what I call the baby bubble, that was the baby bubble of the internet stocks, okay? The first crash after that baby bubble was 94% for the leading index stock, Amazon, 95% for the entire internet index, and it was 78% for the broader NASDAQ. People forget that, okay? That happened in good demographic times. And then after the crash, you weed down to the winners, and then you have a boom that lasts for many, many years. And that internet boom is now peaking in 2021, early 2022. And while this is happening, I'm saying the same thing, we go back, it's happening Bitcoin is emerging, is like the Amazon back then, and the crypto sector, which is not in the index now, it's not in the NASDAQ like the internet stocks were, because it's considered something different because they're not stocks, they're coins. Listen up, they're securities. Coins were the biggest trick in history to be able to launch companies with no launching costs. So a great innovation, by the way, to the crypto sector.
And by the way, Harry, I just want to ask, I don't think I've ever talked with you, at least not much, about crypto in all the years I've known you. Generally, what do you think of the crypto movement, Bitcoin, et cetera?
Okay.
I just got to take that diversion for a second. Yeah.
It's the next, I've been saying this for years. It's the next big thing, but it's in its baby early stage. And that's when stocks get valued the most. But you got a lot of new companies growing faster over the markets, the whole world, and it's going to penetrate everywhere. And then they get overvalued, and there's 40,000 coins out there. Why? Because you can start a company on a coin without the IPO cost of starting a real company, okay? So this is even more crazy. All these coins, all these crypto companies are launched, and they're not going to have 40,000 coins in crypto companies years from now. You're going to have several, just like anything. It's going to shake down to the real winners like the internet did. So I'm comparing apples to apples. I'm not just comparing stocks in the one boom to another. I'm comparing stocks in the baby bubble of an early stage movement, and every 45-year technology cycle, and that's the cycle there. Demographics are about generations about every 40 years, 39 to be more precise.
Right. And by the way,
Harry, 45 years, you get two of these. So internet was the first one, and crypto is the second one, and the same thing's going to happen. A baby bubble, a burst. When how many crypto people I know down here? They're all moving down to Puerto Rico.
Of course,
they're in la la land. I'm a big fan of crypto, but I say you're going to have this 95% burst, and they're like, Harry, that's not possible. Right. I'm like, I go like this.
We'll see.
God bless your souls, because you're going to be shocked when this is what history says happens at this baby bubble stage. And then you get what I call the longer daddy bubble or boom. So again, this is apples to apples. You can't compare the crypto to any other stock boom or something. You have to compare it to the last tech bubble, which was the internet stocks when they were babies in their baby bubble. And Amazon was a nothing burger selling mostly books.
Okay, Harry, I want to ask you before we go further in this interview about just some of your core principles. I started following your work in the late 90s, and I absolutely loved it because, it's very easy to predict how old the population is going to be in 10, 20, 30, 40 years, right? So can you just explain to people, maybe a couple of your core concepts real quick, like the S curve? You say a generation is about 40 years, but most demographers would say, it's 25 years or so. Why do you differ on that? Just explain real quickly some of your core things, if you would.
Okay. Number one, what I look at, I don't look at government policies. Hey, not that it doesn't have an impact, but that's shorter term and more superficial. What really drives our economy throughout history is people who gain skills, grow up from teenagers who do nothing but cost parents and the economy money, and become more productive citizens as they age, get married, have kids, spend more money. And I was the first one to put a specific age on that. The peak in spending in
46 years, right?
46 years old.
Right.
Now that's an important number, because up until 20, when they enter the workforce, that's the average, precise, and I'm not an estimate, average age of workforce entry, where people actually produce something and contribute for the first time in their life economy, to 46 is the spending cycle, the rising spending cycle of the average person. Now richer people spend a little later and go to school a little longer and all this stuff, but that's the average. So I developed back in the mid 80s, the first great leading indicator for the economy that goes decades in advance. Very simple. 46-year lag on the birth index after I adjust for immigrants. And I can adjust, I know the age of immigrants coming to this country, so I can take the immigrant curve and throw them to when they're born after they're here. And I have an immigration adjusted birth index, move that forward 46 years. Now it's 47, okay? But in this last boom, it was 46. That would have told you greatest boom in history, 1983, to 2007, and then the baby boomers peak in their collective spending, and we slow down for 14 years until the millennials, a smaller generation relatively, comes along and has their boom from 2023, 24 into 2037, a shorter, less strong boom. So this is the greatest boom in history. It was already foretold on a 46-year lag. Economists look at me and say, Harry, that's too simple. I'm like, I look at them and say, sorry, you don't understand the economy. People are more important than all the stupid, superficial, reactive government policies you guys spend all your time.
I agree with you. So, if
people
we look,
first, though.
Second
we look is technologies and business. Technology, that's what in this 40. So there's about every, and I don't care what somebody says, 25 years, the peak in generation cycles were 1929, 68, and 2007. Those are 39 years apart to the dot, okay? The technology cycles are 45 years. That's something took me a long time to pin down. And the technologies make us all more productive, okay? I mean, what has the internet done? I mean, I can sit there and do presentations around the world and talk to you and stuff, right from my home office. I don't have to travel anywhere. I don't, this is the type of things that make us all more productive. Sure. That's a 45-year cycle. The demographic cycle peaked in late 2007, and we went into a deep downturn, as we did in the early 30s after a generation peaked there, and as we did into the 70s after the Bob Hope generation peaked. But the technology cycle only peaked recently around late 2019, early 2020. So since in the last few years, both of these most important cycles that actually drive our economy from the bottoms up, regardless of government policy. You think people are going to spend that much differently, whether they make this little law or that, or blah, blah, blah? Yeah. No, people do what it takes to raise their kids and get them into Harvard or whatever their goal.
So if we look at what happened historically, we saw the baby boomers and how much massive impact they had on the economy as at the time, the largest demographic cohort of about 76 million, give or take, Americans, right? And now we see the millennials, and the oldest millennials about 41 years old now, I guess. And so if the peak spending cycle is 46 years, which I would agree with, we've got millennials moving into that time frame. Are we going to have a boom, or are millennials just too poor? And it's different this time.
It's a collective thing, Jason, that this 46-year lag is one of these simple, intuitive indicators that takes into account a lot. Baby boomers started entering back in the, in the 60s or something, okay? But they didn't have enough to have collective power and impact. Millennials still have not fully entered, and the millennials was a shorter surge in births, which did not go to new peaks after that, and was supplemented by immigrants, which got cut off by our own government policies. The millennial boom on that same now 47-year lag is 2024 through 2037. It's a shorter surge. It's not as powerful and strong as the baby boomers. There's a lot of them, but only because they were born from higher levels later and over a longer period of time. But when I just look at the surge that's caused by rising spending of rising numbers of people, their boom is shorter, 2024 to 2037. And the problem we have now, these poor millennials, because the baby boom had this giant debt bubble, and governments won't let these debts and zombie companies get cleared out, they're never going to have a boom that's fair to them, because we're going to carry all this debt and zombie companies with us. So we need, economists don't understand this, we need recessions, you idiots. Recessions clear out the dead wood. God wasn't stupid. We have booms and busts. We have dark and light. You see this duality in everything there is, okay? We have men and women because they're different. These recessions, don't say we can't have a recession, and if you say that, then you do not understand how the economy works, period.
The powers that be don't want to take the tough medicine anymore. There's no Paul Volcker around. So what do we do? But tell us what's going to happen. Like, that's what we want to know. What's next?
You can't do anything about this. All you can do is get out of the way when the bubble's about to burst. Okay. So I've been studying this bubble. I predicted the first one, not only in 2000. I predicted that boom would peak in the 1980s. decades, because it was set in stone and governments were not manipulating the economy nearly this actively, okay? So it just happened. Well, they've been fighting ever since. Well, it keeps taking more. You know, they printed $3.5 trillion after the 2008 recession in the early stages to get us out of that funk, but they printed $4.5 trillion just since COVID. This is how it's taking more and more. That's the
it's insane. Yeah,
taking that much just to keep us barely growing. And I look in the stock charts and I'm saying this stock chart looks like it is peaking right here, January 4th. I'll tell you what I look for, Jason, for a long-term peak to confirm it beyond factors when I don't have these demographics working because the governments have suppressed it. I look for more and more sectors to peak and narrow down to the largest cap sectors. Down, the last one to peak was November 22nd for the NASDAQ, and then the S&P 500, the largest large cap, safest kind of sector, in January 4th. And before that, I've got 12 major stock indices and sectors and global that peaked in a succession, saying this is a major top, and it likely peaked on January 4th when the last major index finally peaked. We're now down, I think, 18% on the NASDAQ, maybe 12% on the S&P. This has to go a little farther to show that it's really that first crash, and it's going to happen very quickly if it does. No, mark my words on that. If it is so, this bubble is over, and when bubbles crash, there is, and mark my words on this, no soft landing ever in history after a bubble.
I appreciate the passion, but Harry, I want to get to some specifics. So first off, I know you have a few other charts. I want to make sure you share them. So let's look at those and talk about them. But the question is, what is going to happen? Rather than just saying, you know, bubble's going to pop, right? Tell us, like, when. I mean, you talked about 2024, but that seemed like this would be a positive time because the millennials would start to really kick in the spending, which will boost up the economy. Yeah, but I guess that's not the case. So
the economy is vulnerable into late 2023. So we're still in a weak period, and it gets weaker. Okay, the economy's only gotten weaker since that peak in 2007. I also projected decades before it happened that the weakest part of this economy, this downturn after baby boomers, would be 2020 to 23. That's always been my bottom projection. Late 2022 for stocks, 2023 for the economy. Now that we've pushed this off so far, that's probably going to come a little later, but not a lot. So we're still in a weak period. And what this first chart shows, this is what happens when a baby bubble and a daddy bubble, the NASDAQ broader, and the baby bubble now in crypto peak together. It's not a 20%, 30%, 50%, 70%. It's a 90-some% crash in the leading sectors and 80% in the broader thing. That's what we had in the early 30s, 89% correction in the broad stock market. Of course, the leading, General Motors and the leading were down more, whatever the most bubbly. So that's what I'm showing here. You got to look apples to apple. This is not an ordinary peak. It is a once in a lifetime peak of a major bubble in stocks. And this is the final bubble to burst. And this one, unlike 2000 and 2007, is an artificial bubble, which makes it even more vulnerable. It wasn't even built on anything real except for just pumping more money in the economy, which goes into the financial markets, which makes companies more valuable, makes people more rich, makes
rich people richer. Yeah.
Well, it makes everybody a little richer, but yes, it keeps the economy, but it makes rich people a lot richer, and the leading companies a lot more overvalued, and that's what booms. That's what bursts most. So I'm here, Jason, to warn rich people. The rich people have the most to lose here, and they're clueless because they think this can't go down.
Got it. Let's get to your next slide if we can. Harry, I got to explain for people listening audio only. So this is S&P 500 downturn, similar to Dow 1929.
The red line is today, the last month, a little over a month, starting from that top, potential top, January 4th, okay? Is this the top? I'm tracking this versus the same time period in the early Dow 1929 crash. Dow was the leading index back then. S&P is now. And it shows, it starts slowly because, hey, other indexes have crashed faster here. But no, the S&P 500's held up the best so far. But this shows we're just about, literally in the next week or two, about to enter the phase where even the S&P 500 starts falling apart. So that'll be a sign to me. If this is that first crash, I'm going to know in the next week or two if we're following that trajectory and we're going to go down. And next thing you know, look at this. By mid-March, mid to late March, we could be down 45 to 50% in the S&P 500 if we just follow the same scenario.
Okay, so just to be clear, so predicting a stock market crash, bubble bursting. Okay, what else?
This is only the first crash
of
a broader 2 to 2.5 year crash that in 1929 to 32 took stocks down 89%, and I'm projecting 86% for the S&P 500. Okay, in this one. Okay.
Wow. So an 80. Wait, let me just make sure we're clear on that. So an 86% decline in the S&P 500. Wow. Ouch. That is going to.
I'm not looking at that here. The important thing is, are we in that first crash yet? Because I've also done analysis that shows that the first crash, I did all the 7 major stock bubbles in the last century plus, okay? The first crash averages 46% in the first 2.3 months. 46%, okay? So it's going to go down 80 to 90 if it's a real major bubble like 29 or now, or 2000 for tech stocks, as I showed earlier. But I'm focusing on the key thing. Are we in that first crash yet? Because if we are, then the rest of the scenario follows. And if we do go down 45 to 50% in a couple of months, like by the end of March, what do you think the Federal Reserve is going to look like? They're going to lose all credibility overnight from my point of view. People know when they hear, oh, they're just printing money. Well, it sounds fishy, but it's worked so long. People are starting to believe maybe it's, and experts. Warren Buffett says they're doing the right thing. Sorry, Warren, I thought you had good common sense. This is wrong. Printing money to keep a dead economy alive and not allowing it to clear.
Yeah, but Warren Buffett's just an insider kind of elitist. He doesn't appear that way in his personality.
Is now,
but
he
yeah,
wasn't in the past.
Yeah,
but I thought he had common sense.
Yeah,
he's telling people you can't go wrong buying long-term leading U.S. stocks. I'm saying you're going to go as wrong as 1929 to 32 likely here. That is the opposite of that.
All right. So we got the stock market crash you're predicting. What else? Take us to the next slide, if you will.
Okay. Well, this is just showing now Bitcoin. Remember I said Bitcoin is like the leader, it's like Amazon for the .com stock.
Okay.
It's the leading crypto coin.
Asset. Sure.
It's really security, but it's a coin. Okay.
Yep.
And it is farther along this, and it has also followed that first crash scenario back to 2000. Not quite as steep. So this is another confirmation that this is looking like that first crash. And then here's the last stuff. Here's the last slide. And here's where I am different from Peter Schiff and the gold bugs. Peter Schiff is just as bearish as me. Most of the gold bugs are. They understand you can't live off printed money. They understand bubbles. But I say gold is not the safe haven, because we're going to deflate. When all these financial assets deflate in value, money, all this created money that went into these inflated assets is going to disappear, Jason, disappear like a magic act. Poof, and it's not going to come back for a long time, okay? So deflation is the scenario. Peter Schiff sees an increasing inflation bust, more like the thing in Weimar, Germany and stuff. So that's the difference. So I look at treasury bonds in a deflationary scenario, like the early 30s, like 2008 and 9. It was the treasury bonds. Gold went up early, like it's doing now, in the crash, and then crashed with everything else down 50% overnight. It was the treasury bonds, 10 and 30-year U.S. treasury bonds, AAA corporates. They're the real safe haven, things that will not default even in a downturn. And I'm showing the difference between a 20-year ETF called TLT, average 20-year. There's 10 and 30-year bonds combined, but they're leaning 20-year average. ZROZ is an ETF that leans later 25-year, more the 30-year bonds, which are more potent. And I show that if you use this as a safe haven, the ZROZ is going to do 2/3 better in a crash than the TLT, only this crash. So I'm just comparing it to the COVID crash, okay, which was a short-term crash. But look what happened. Look how much TLT went up 53% and ZROZ went up 89%. So these are type, people understand that if you're in the safest long-term bonds The leverage is the long-term duration of those bonds. This sort of shift can cause bonds to go up 40, 50, 60%, only the safest as a safe haven when stocks are crashing 70, 80, 90%. So I'm saying there isn't, people say, where do I go? No, is there a diversified portfolio? No, the safest bonds are the only safe haven, and even gold in 2008 crash failed in the end, so ended up down.
Okay, so you're saying bonds, so but it's kind of
the highest quality government.
I got it. Okay,
so you're saying will not default no matter what.
Understood. Well, not in nominal terms they won't, but in real terms they
might. Hey, if they can print money to goose up a kind, they can print money to pay short-term debt payments. They will not default in this downturn. They may fall somewhere down the road, so not default in this. And money's got to go somewhere. It's cash or these long-term bonds. The difference is cash will preserve your money while everything else falls, which is a huge advantage because you can buy everything cheaper with that preserved cash. But these high-quality bonds will increase the value of your money substantially. This is a secret. Gold will not. Cash will not.
All right. So most people would say that those two asset recommendations are kind of for opposite purposes. If you think there's going to be deflation, bonds would be good. If you think there's going to be inflation, gold would be good. But you're recommending both of them simultaneously. Why?
Well, inflation always comes in the late stages of a boom because things are, and the government is so overstretched. That's what we started out talking about.
Yeah.
This economy is so overstretched. I mean, the baby boomers stretched it naturally. Now this is just stretched it. So inflation comes late stage, and only if you get in a situation like Weimar Germany, real quickly, people misunderstand that. Basically, Germany borrowed money for overseas and from other countries to fight a war, lost it, and then collapsed, and then their currency collapsed, and the currency collapsing made those debts 10, 20, 100 times higher. That's why they had hyperinflation, had to print money. That is not what happens in most major bubble boom bursts like 29 to 32. I'm not comparing this to Weimar Germany, eat with the money. I'm comparing it to 29 to 32 when the greatest bubble back then burst and financial assets collapsed, and that ended up ending where the only thing that went up was the very safest financial assets, and that is the very best corporate and government bonds. Even something that has a little default risk is going to be devalued. These are the no default bonds, 30-year treasuries, 10-year treasuries, and 20-year AAA only corporates.
So to be clear, are you still, I mean, for a long time, I know you, and I've had Bob Proctor on the show. You recommended him. I know you guys think alike about a lot of this stuff. And that's the Elliott wave theory, just so everybody knows who that is. So are you still thinking that the future is deflationary?
Well, it's a temporary thing. Deflation is simply deflating a financial asset bubble. Money, which is created by leverage, and excessive financial stimulus, in other words, artificially gets taken out of the economy so the economy can go back to normal, flush out bad debts, but companies that would not exist without all this funny money and all this stimulus, and gets us to where we can grow again. So that's what Bob Proctor and I see. There aren't many people, like I say, the other people saying there's a crisis coming just think it's going to be hyperinflation. Peter Schiff, the gold bugs. So Proctor and I are not with the gold bugs in this. We agree that money printing doesn't work. We agree it's not sustainable. We're going to have a big crash. We see deflation instead of runaway inflation because these financial assets, Jason, if you think governments are fast enough to print money to keep up, now let me throw a number that's important. Everybody remember this most important number in the world right now. The biggest number in finance today is $540 trillion in
derivatives
globally. That is 6 times global GDP.
Okay. Yeah.
Now that's the mountain that central banks, by all the stimulus, have doubled that number from what it would have been normally, even in a normal bubble. And that's the thing that when you get an avalanche, it starts to slide. 540 trillion, and that starts to devalue at the speed of light. What did I say that first crash was in almost every bubble? 40 to 50% in a couple of months. That's what kills the Fed. That's what says this is a bubble. That's what says we were all nuts. Why were we doing this? People will get this very quickly. That's why I'm looking at this first crash. The first crash will make this evidence. Until we have this first typical historical 40 to 50% crash in 2 to 3 months, it won't be, people will think they can keep this going. That's
our consumer,
they ran off the road, the car is wrecked.
Are consumer prices going to keep going up, or are they going to come down?
They go down.
They go down. Okay.
Financial assets go down. All this money, especially rich people,
and consumer prices.
Competition. Who can buy the biggest? All I do is see the bigger yachts that's coming out. Okay,
right.
All that ends. People are be defaulting on yachts. They're gonna be defaulting on homes. People have bought 2, 3, 4 vacation homes now. You got to do something with all this money if you're wealthy. Okay, all of that stuff freezes up. Everybody freezes up. People stop spending. Consumer prices go down. But most of all, financial. The most important number is $540 trillion in financial assets globally, and I think it's 130 just in the U.S. I think that's the right number. I'd have to look that one up, but it's something like that. We're 20% of that number.
Yeah. So that doesn't even include derivatives.
Well, derivatives is all part of this financial asset thing.
Right, but the derivative number is
money out of the economy, and that reduces spending, and then the spending makes the economy worse, and that makes the financial assets go down more. And then it's something that governments can't just say, well, we'll print another 10 trillion and get out of it. 10 trillion doesn't stop a 540 trillion avalanche. That's my view.
Yeah. Okay. Before we wrap it up, Harry, I think you got a couple more slides, and I just want to make sure we get them in.
No, that's it for today. I only pulled out. I knew we didn't have that long. So
okay, good.
There's tons of stuff, but I mean, this is the important stuff near term. So if we see now, interest rates have already gone from 0.5% on the long bond to a little over 2 here recently. I think that may be. I was looking for 2 to 2.2%. That's enough coming from 0.5% to trip a stock crash. See, stock bubbles are almost always in when interest rates rise, because people can now get higher returns in bonds, and it raises the cost of business stuff. So, but when you're in this low in inflation and interest rates have pushed artificially low, to go from 0.5% to 2.05 recently is a big move, and that, I think, is what's pricking the stock bubble. And I'm just saying, what really happens here, what kills this thing, despite there's no central banks are not going to stop printing money, not going to stop escalating. What kills it is the stock market finally has that first 40 to 50% crash or more in a couple of months, and that is a wound that the economy and the financial markets cannot come back from. People lose faith in the money printing scheme, which always was something for nothing. The fact that anybody thinks it's one thing to print money in 2008 or 9 for 1 year to help a down economy.
I get it. Totally agree. Yeah.
To print money nonstop and exponentially more for 13 years is insanity.
Yeah, but the people who own assets and the insiders are all benefiting from that Cantillon effect, and the rich are just getting richer, and the wealth gap is getting bigger and bigger, and the whole thing is a giant scam. I think we all agree with that.
I'm in Puerto Rico because I've always come here. I moved here without the tax thing and got it anyway. Okay, but the average person from the U.S. moving here, 20 million net worth. These are the people who probably should be worth 3 million. Okay, because of this bubble, they're worth all of this, and they're moving down to Puerto Rico so they don't have to. The zero capital gains in Puerto Rico if you qualify. It's a gringo moving down here. So they're moving down here to protect that wealth. The problem is the stock market's going to do it for them.
Wow,
they're not going to need to worry about the taxes. They're going to have losses forever.
Yeah, wow, that's something. Yeah, it's crazy time, Harry. Okay, just wrap it up with any specifics, or maybe that was your wrap up. Whatever you want, give out your website.
This is the most critical point in your lifetime for financial markets. What I'm saying. Okay. And you simply have got to say, don't be a pig. I hate to say it. You've made artificial gains for a long time because all this stuff. You've got to question this. I'm telling you, just protect yourself. Get out of risky assets, stocks, real estate. Hey, you may keep your primary home, but sell your damn vacation home that you use a couple weeks a year, or maybe 2 or 3 because you can't lose money on them. You have to get out of risky assets, protect yourself here for a short period of time. I'm not talking about don't invest forever. I'm talking about just for a year or two for this crash to happen, and then the world will be your oyster. The bubble of a lifetime bursting ends up being the sale of a lifetime on financial assets, which means the buy opportunity of a lifetime. I think by late 2023, give or take, that people are going to be able to buy financial assets, real estate, houses, bonds, stocks, whatever, the best companies and things that survive after all the zombies go under, at the lowest rates you will ever see, like buying in late 32 or late 1982. That's this sort of, you got to get out of the way to preserve. Otherwise, how do you reinvest when you lost all your wealth and that? You got to get out of the way, get out of risky assets for just the next, let's say 2 years max. And then if I'm right, the world is your oyster and you can reinvest for the millennial boom from 2024 to 37, not something I've been predicting way before it happens. Okay, always been predicting that. You can invest in the best global stuff for the next boom and buy it at the sale of a lifetime. You will never see this again. So this is the most important time in your financial life. Wake up and look into this. On harrydent.com. I've got a free newsletter you can get on, but right now I would get on my paid newsletter because I can't share but so much on the free newsletter, but at least get on the free newsletter, harrydent.com. And our paid newsletter is peanuts compared to what's happening here today. You know, it's like $200 something a year or something. I would get on that now. Just give me a year or two. If you don't like me, you can throw me out after 1 year, but I'm telling you, I don't know who else is going to guide you through this. I mean, there's not many people I can recommend in this time, and Robert Prechter is one of them.
Harry, I got to ask you about one more thing because you just made me think of it. And when I discovered your work and started reading your books in the late 90s and really enjoying them, by the way, you were talking about how the stock market would really start to suffer right around 2010, give or take. And, the financial services industry looked up to you like, I mean, you were God, you just, because that would be retiring baby boomers would start and they would unload their big homes. And large homes would also really suffer starting about 2010 to maybe 2012, I think, correct me if I'm wrong. But, that sort of didn't really play out that way. And I'm wondering, what do you attribute that to? Was it just that people put off retirement, or they just, they didn't act in the sort of the way we thought they would? I mean, people are living longer, their health span is longer,
When you're given something for nothing, who's not going to slop it up?
Right.
I mean, who's going to sell your house when it goes up 20% a year, even when it's already overvalued? And people keep buying. People are buying 2, 3, 4 houses now. They're buying multiple vacation homes.
Yeah. So you don't mean for investment. You just mean they're just buying homes as personal residences.
Well, they're buying it just for gains. They're just speculating.
Right. Yep.
So everybody's in a bubble like this. See, the whole purpose of a bubble, Jason, is to draw everybody in and then flush out all the dumb money. So if you're buying stocks now at the late stage of this, or real estate still, you're the dumb money. That's what I'm telling you. I don't know if you want to hear it or not. You're the dumb money, and you're going to get crucified while the smart money slowly sneaks out when they think it's overvalued.
I'm especially curious about the McMansions. I mean, the stock market didn't crash as you predicted. The McMansions didn't crash. What's going to happen to the McMansion market? I'm just.
Well, I'll tell you 2 things. I got a house in a normal neighborhood, and I got a vacation house, and I want to sell one and keep one. Sell the vacation house. They're more volatile. They're more speculative. If I got a McMansion, a big house with 5 bedrooms, and a smaller one with 2 to 3, I keep the smaller one 2 to 3 and sell the McMansions. They're the most overvalued and most overbought in here. So the point is, everything. You can look at everything. Look at everything since 2000 and since the 2002 low, and then again the 2009 low in stocks and real estate and stuff. We're going to at least go down to 2009 levels, and probably more like the 2002. How much do you lose? Are you willing to take that sort of loss? And that loss is going to shock you when you look at how much assets have gone since then. This stock market since early 2009. I don't have any time in history I can compare to this artificial, and that's the word thing, artificial, not even the 22 to 29 bubble was a real boom. It just got out of hand with speculation, and low interest rates, and stimulus, but you can't even compare to this. This thing is the greatest bubble, particularly in stocks, ever in history. And history says it will end not just badly, very badly. And when it finally does crack, there is nothing to put Humpty Dumpty back. There's no stimulus that can react fast enough when this thing finally.
I mean, won't they just print another 17?
And it'll be too late. Did you hear what I said earlier?
Yeah.
Sure. Here's the number. Everybody remember, $540 trillion in massively overvalued financial assets, stocks, bonds, real estate around the world. Great majority of that in the United States, of any other country in the world, is going to disappear at the speed of light. There is not enough money you can print fast enough. They're not that quick. These not so smart. Anybody stupid enough to think you can keep economy going on something for nothing forever can't be smart enough to print money that quick.
I think the problem is with all of these predictions is nobody really knows, because we're in uncharted territory. Nobody knows how far they can keep kicking the can down the road.
That's why I'm focused on the first crash, Jason. Yeah. It's that simple. I don't even know, okay? Right. I can tell you when the stock market looked bubbly, which it did coming into late last year.
Sure.
But I don't know.
And you know, Harry.
I don't know. Listen to me for a minute. I don't know that it's over till I see that first crash. Then I can say, this is done. Yeah. The problem is, if you wait till I can make that proclamation, you're going to be down 50%, probably panic there, and it'll be too late. I'd rather people be safe now. See if I'm right. You don't have to wait long to find that out. We're just talking a matter of months here. But if I'm right, this thing's going to happen fast and hard, and it will be obvious when it finally happens, and it'll be too late for most people.
Yeah, good stuff. Well, Harry Dent, thanks for joining us, and we'll see how it all turns out. And everybody, now is the time to be aware and pay attention. This is not the time you can just ride along as a passenger with all the absolute craziness that's going on in the world today. We appreciate you joining us, and look forward to having you back. Thanks, Harry.
Okay.